record. All right, welcome everybody. At this time, I'm going to turn it over to our speakers. We have a lot to cover today. Kurt, I'll turn it over to you.
Yes, I thought to start out to introduce myself a little bit. My name is Kurt Smith. I'm an assistant professor of forestry, an extension specialist here at NC State University. In addition to teaching, I also work in the area of land retention. And so tax strategies and tax schemes are a big part of that, a way to keep small land owners and small forest owners in particular viable and profitable. So that's kind of what I do. I'm a graduate of both Oregon State University and NC State University. And I think I'll let Kevin say something about himself.
All right, yeah, so good afternoon. I'm Kevin Burkett. I'm an extension associate with Clemson University. I work in the area of farm management and taxation as my role here at Clemson, and have been here about 3 years. But I also work with the Clemson Tax Schools, which is a continuing education program that we put on around South Carolina for tax professionals. And so, and prior to that, I was working with Auburn and Alabama Cooperative Extension in a pretty similar role. So have some experience and some background in this area. The timber area is a little bit newer for me, but have worked with some folks in that, and hope to be able to share some useful information in conjunction with Kurt today. So he asked about possibly doing a presentation together and kind of doing a co-presenter here. So anyways, looking forward to getting started and sharing some of the information with you.
So before you guys kick things off, let's remind people where they can get their information today. The slides for today's presentation are available on the portal where you joined today's webinar. You scroll down, you'll see related files and related web links. So the links they talk about in today's webinar will be available there. And then we will take questions and answers at the end of today's session. So as you get questions, please enter them into the Q&A feature on Zoom by clicking on the Q&A icon, and we will get to those at the end of today's webinar. And with that, Kurt, I'll turn it back over to you.
Okay, we'll see if I got my slide share going here correctly. I'm hoping I do, so that everybody can see the slides. Can you view those now?
You have to click shares, Kurt. We don't see them.
Okay, working on it. All right. See. Share screen. 2. It's gracious.
There we go.
You got it?
Yep.
Okay, very good. Let me get started. I'll see if I can advance them as well. Yep, okay. And click back. All right, I apologize for that. This is kind of new for me. I did want to start out by just giving you a qualifier. I talked a little bit with Kevin beforehand. We don't want anybody to get the idea that you should walk away from this sort of satisfied about your tax situation. And sort of also just the fact that everybody's tax situation is so different, laws change. Goal really for this presentation is just to drive you to go see a tax professional before you make a big decision, particularly in forestry, I'll have to say, because as opposed to other kinds of agriculture, tobacco, cotton, and the like, maybe you'll harvest once or twice in a lifetime. You realize that profit. So it's really extra important that you get it right when it comes to taxes and paying capital gains. So treat us as information, treat us as education, but don't make tax decisions based on what you hear today. Tax strategy, as I mentioned earlier, is really just really one of many things. Land retention. Land retention is so important.
Kurt, let me pause you for a second. Can you put a headset
Yeah.
on? Your audio is very broken up. I think you're going back and forth away from the mic is making it hard for people to hear. If you got a headset, could you put it on?
I do not have a headset here with me though. Is that any better?
Yes,
Can you hear me now?
yes.
Okay, I'll try to talk clearer and louder. I don't have the headset with me. But what I wanted to say is when it comes to land retention, there's a lot of tools in the toolbox to keep family forest owners in business. So I work with cost share, estate planning, succession planning. But as I said, a tax strategy for a crop that you cut maybe once in your lifetime or twice is really critical. Why do we care? So this is a national audience. One reason you care is 4% of our GDP in the United States is predicated on forestry. So it's big business nationally. In North Carolina, where I'm situated, a big ag state, it is over $100 billion in ag and over $32 billion of that is in forestry. So very, very important. And then in terms of land loss in North Carolina, we're probably slated by the year 2040, they project, to lose some close to 1.1 to 1.3 million acres from development. So for all those reasons, we really want people to stay in forestry. The other thing dealing with fragmentation and why we want to keep people in forestry is the aging population of our landowners. The average one now is close to 62 to 67 years old, and the average size of a forest holding is down to 29 acres, which kind of points to this idea of fragmentation. So that's going to affect a lot of dealing with forestry throughout the South. So shifting to taxes, which is why we're all gathered here today, for sure and for certain, is timberland value is separated out largely into two components. And Kevin will probably break some of this out even much better with more depth. But one you need to look at is the land itself. And then secondly, look at the uncut standing timber. It's worth at the point of purchase or when you get started replanting to separate those things out. The value of each should be separated if you want to try to maximize your tax advantages. So the difference in terms of getting capital gains, you can save yourself a lot of money if you realize the benefits of looking at your timber while it's standing. Once you cut your timber, it'll be treated as ordinary income and subject to a lot of taxes. But if you look at it, standing timber from the point of purchase forward, you may have the ability to save a lot of money in capital gains. So basis, just sort of real primer, if you get into taxes at all, you'll see this term come up. And so what is basis? It is not the cost of your land, timber basis. It's the value of your timber from point of purchase forward, less the expenditures that you make on that property through improvements, cost share, that kind of thing. The other really important thing, and there's a web link at the bottom of this slide if you can see it, and you can learn a little more through our extension website. There's a great fact sheet there on understanding your timber basis. So I'll just sort of commend that to you to take a look at that. The other issue when it comes to taxes is consideration of how did I acquire the property? So three ways generally that you can inherit it. There could be others, but the main ways might be through a gift. The second would be through an inheritance and the other through purchase. So those are the three main ways you could get land probably for timber. And each of them have sort of differentiated tax implications, if you will. So forest land that was purchased, in that case, your original basis would be the amount of your total acquisition costs allocated to the timber. The other way might be if you inherit it, and then it would be based on, your basis would be based on fair market value upon the decedent's death the date of his actual death or her actual death. If the property you got it was received as a gift, the basis is generally the donor's basis plus the gift tax, which can be quite a bit. So just knowing how you came into the property can help you sort of prepare and modulate your tax strategy. So how do I figure out if I bought property 20 years ago? How in the world am I going to figure out what my basis is? This 20 acres or 40 acres had timber sitting on it, maybe 30 feet high when I got there and I bought it. So how can I figure out what my timber basis was from the time I purchased it? So I was going to give just a very brief overview of timber cruising, and then another thing called back cruising, and the two sort of work in concert with each other. So a timber cruise, and I realize probably a majority of my audience will know what a timber cruise is, but there'll be some that won't. So made very, very simple, if anybody's had statistics, you take random samples, so sampling plots throughout the property. Maybe you'll look at 5% of the property, and you'll be able to extrapolate to the whole from a small sample. So a forester, and I'll point out you should probably work with a consulting forester here because it's a bit of a technical process, but essentially you're going out and random sampling, looking at heights and diameters of trees and calculating the value. Also looking at the species, because that can affect the market price, composition, and other things. It's more than a guesstimate. It's not a guesstimate at all. So there's some science base, which is very important in the tax game, that you have something defensible. So how do you get to a back cruise? That's a snapshot of what happens, of what our timber's worth today, right now, as I'm getting ready to cut it next year. Well, what a back cruise does is it takes the data from a cruise, and then it regresses to the time of purchase. So that can be done, at least in part, through the use of an increment bore. You're able to look back and see how much wood or how much growth that you've accrued since your point of purchase. And that can become your point of basis. So that can save you money. So really fast point, I'll just say, is back cruising is prohibited, not prohibited, but by the IRS isn't fair game once the timber is cut. So so in other words, you sort of have to know this going in. Once you cut your timber, you're looking at ordinary income, and the whole basis argument is somewhat moot. The other really important consideration when you look at your timber as you're getting ready to harvest is you'll need to, the IRS is going to want you to classify that property, or you'll be asked to classify that property as either a hobby, an investment, or a business. And all of those have sort of different rules by the IRS, and you'll have to sort of sort through that and figure out, well, what constitutes my 40 acres being a hobby or an investment or a business? So for a hobby, and you see this a lot now, people will buy 20 or 40 acres, and their purpose is to have a place to go out on the weekends. Yeah, they'll probably cut the timber in loblolly pine in 30 years, but their real purpose is personal enjoyment. They'll camp on it, they'll take their kids to it, they might four-wheel on it. That's a hobby, that's personal use. Tax deductions under that scenario, the hobby scenario, are really quite limited. In terms of an investment, if your property is classified as an investment, that means you're in it to make money. So there are faculty, for example, where I am, that have maybe 40 acres down in another state. They may never actually see it. They don't need to see it. It's on a rotation, probably managed by somebody else. They're looking to get return on their dollar at some point in the future. That is an investment property. And the final class, which really is the one that has the most favorable tax deductions associated with it, is a business. So if you have that profit motive, like you do for an investment, but your involvement is pretty regular, pretty continuous, and pretty substantial. And I realize those terms need definition, but some of that is up to you to make with the IRS and for you to substantiate or make that case and for them to accept it. But that would constitute a business, and that would give you much more favorable tax deductions. So there are some things that can be excluded from your income, and what they call an income exclusion. A lot of you forestry owners out there are participating in cost share programs through state programs, NRCS, soil and water, and so forth. Programs like the Forest Health Protection Program, FHPP, the CREP, the Conservation Reserve Program, and the Environmental Quality Incentives Program, EQIP. And then there's I could probably make a list of all kinds of small programs that are run within the state architecture, if you will, of conservation and forestry. But they may qualify for income exclusion. And in each case, the smart thing to do is to talk to the program administrator and determine if that program qualifies for income exclusion, which obviously could save you a lot of money. There's also a link on the bottom there that covers some of this material. I'll just commend that to you too. Tax tips for landowners. You should see that link as well. So I've covered a lot of this stuff really quickly, and apparently a few glitches in there too. I do apologize for those. But the key takeaways, I think, are it's important to take your forestry investment seriously, since you may only do it once in a lifetime, or maybe twice if you live long enough and it's pine. And also to make use of basis from the point of purchase forward. Then the other thing is to understand whether you are a hobby, a business, or an investment. And then finally, how did I get to this property? Did I buy it? Did I inherit it? Was it given to me as a gift? All those things will suggest different tax structure and different tax architecture. So I think that's the main thing. And so realizing this stuff, obviously, the hope is it's going to keep, when you get to that 30-year cycle, the profits are going to be enough that the landowner's going to want to replant, going to want to stay in forestry, because he didn't get killed, beat to death on taxes, and was able to realize a profit and want to stay in it. So with that, I think go ahead and turn it over to Kevin. If you want to call your slides up.
All right. Hopefully that showed up for everybody. Okay.
It's here.
No, great. And just as a side note, my laptop is the one that has my camera on it, and so I have a bigger monitor to my left where my actual presentation is. So I'm going to be focused on the left side a little bit more. So if it looks like I'm looking away from you, that's the main reason why. But I like to work off that bigger monitor, so that's the reason. So, but anyway, no, that was a good overview by Kurt, and I'm just going to really just add in some of the tax implications and a little bit more detail to some of the things that he's already mentioned. And so we'll walk through some of this. So really, record keeping, and this is true for a number of farms that we work with, but I know also on the forestry side, record keeping is really at the heart of a lot of these issues, and especially as we talk about some of the land transfers and some of the basis issues and calculating gains and things like that. If we have that really solid data and those really solid records to look back to, it reduces so many of those issues. And with the record keeping, it's like people almost hear that and they think it's a bad word, or they cringe a little bit, but it is a little bit more work on the front end. But I think you realize so many benefits later that it's in your best interest to really have that information on hand. And so it's not so much that you use those records every single day, but really there's going to be some important times that come up where if you have that information on hand, it's going to save you a lot of headache and a lot of stress and things like that. So sometimes when we work with producers, they, we work for the university or we work for extension, and they almost think that the records are somehow going to end up in the hands of the IRS or the government or something like that. But I mean, I assure you that's not the case. And we don't see those records unless the producer decides to share them with us. And so, if they're the only ones that have that information on hand, or they decide to only share it with them and their spouse, that's up to them. But I think still they're going to realize the benefit from that. And those situations that do come up where they need that information and they need something verifiable, then that record is really going to come in handy. So we just encourage people from that perspective. And myself and a colleague here at Clemson, we came across a couple situations in the past couple years, and this is a little bit more on the farming side, but in an operation, there might have been one person that was handling a certain aspect of that operation. So, like on the farming side, it might have been a manager that was specifically in charge of the livestock. And so something may have happened, whether it be an accident or COVID or just accidentally passing away or something like that. And suddenly that person was no longer available and was not able to handle their task related to the operation. And so that fell to someone else in the family where they had to kind of pick up the baton and move forward with it. And, in farming, it's a little bit more immediate. And I know timber is more of a long-term process and activity. But in those situations, those family members, if they have to pick up the information and kind of continue the activities, anything that we can list as far as like resources, maps of the property, contacts and things that the new manager of that property can pick up and use, I think is going to go a long way towards helping that person. So we kind of got a couple of calls from folks where they said, well, yeah, I mean, they always handled it and now they're not available and I don't really know what to do. And so those like maps of the property, the lenders, just all that important kind of information, I think is important to communicate to someone else. And that probably gets into a little bit of like succession and estate planning. And we're not really going to touch on that today, but this was just a short article that a coworker and I had done. And it just lists a couple of resources from other extension programs where they have a template for land, like farmers and landowners to use, where they can list this information. So if those situations do happen, then you have it on hand. And again, that person that has to pick up that activity, I think is really going to appreciate having that information. So, and it can include your 5-year plan, your 10-year plan, and so on and so forth. And I know from a forestry standpoint, typically you have like a forest management plan, and it doesn't have to be like these templates, but it's just something that I wanted to mention that I think it's important to communicate some of that information. So we wanted to make it just a little bit interactive. So we have our poll questions through the Zoom that we're going to ask to you as participants. So we had somewhat of an idea of who was online with us, but just to get a better idea, we'll have a poll question for about 30 seconds. And it just says, are you and you can select multiple answers here, but are you a forester or some kind of forestry professional? Do you work for an extension or a university? Are you a landowner? Perhaps there are some tax professionals, and maybe there's some others that work in other industries, but maybe you have interest in this information. So we'll just give you about 30 seconds or so to respond to this, and then we will review the results briefly. And my thought was it would probably be mostly landowners and some that work with in the area of forestry, maybe be consulting foresters and things like that. And so as we can see, the main component here, a little over 70%, about 75% is either foresters or landowners, which is great because I try to tailor it more in that direction as far as some of the material that we're covering. So Kurt already mentioned a little bit of this, and I'm not going to dive too deeply into it, but he did do a good job of kind of explaining the basics there. So we do have 3 classifications for how we look at our timber activities. And a hobby is something that mainly there might be a landowner and they might have timber on an associated property, but they're really not looking to make any kind of money off of it, but it's more so just a personal enjoyment from that property. So they might hunt, they might chop their own firewood or something like that, and they might even occasionally sell some things from that, but it's really, they're not intensively managing it and maybe not intensively managing it for profit. And so it's more of like a side activity that they enjoy doing. And so it kind of steps up from there. So then we have more of the investor side where the intent is to make some money from that activity. And with the investor side, typically we think of you're wanting to see appreciation and income from those assets over time. So we realize it's more of like a long-term thing, and we might have some sales from the property and from the timber, but it's not going to be real frequent. And so, some examples I've heard of people wanting to use that as their retirement, for instance, or perhaps they have some kids that they want to send to college. And so they've got this that they do consider it an investment, but they're not trying to harvest like every year or something like that, but it's more of a longer term thing. So I'm primarily going to focus on the investor and the business side because I know really around the Southeast, that's the primary classifications. And really as a hobbyist, I don't think they would really be joining a webinar maybe like this anyway. So, and then the business is even a step up from there where it is pretty intensively managed. There's maybe significant time spent in the activity, and it's even more consistent and annual activities each year that we're having pretty frequent sales. And I think sales is one of the biggest contributing factors between is it an investment or is it a business? So a business doesn't necessarily have to be every year, but still pretty consistent and pretty not as sporadic as the investor side of things. And so on a business standpoint, we do get to deduct our operating expenses and take some deductions a little bit earlier than we do from an investor standpoint. But those 2 classifications are going to be our most beneficial. So I probably don't need to tell anybody this, but I mean, taxes can be complex, and especially as you start to dive into some of these areas. And so really for this presentation, I wanted to keep it fairly simple, which is kind of hard to do, but really just that you have some 2 or 3 takeaways of the main issues. And so if you're discussing it with your tax practitioner or your family or someone that you consult with, that you have a real kind of basic understanding of some of these issues and how to approach them. And so I think when you talk taxes, people think of the IRS knocking on their door and suddenly, I did something wrong and they're going to come ask me a lot of questions and that we might get audited or something like that. And that's not to say that that can't happen, but it's, I think the bigger issue might be that landowners are unfamiliar with some of these areas and they actually end up probably leaving some money on the table. And it might not be that if the landowner is not preparing their own return and they're not filing their own taxes, then, they're just unaware. But working with a practitioner that has knowledge in this area it's going to be a valuable relationship. And I think that landowner having some knowledge and being able to ask some questions and really find a preparer that can work with them appropriately, I think just like a consulting forester is going to add value to your timber and to your property, same thing with a tax practitioner that has knowledge in this area and can really steer you in the right direction. So I would also say just find a practitioner that you can work with. And there's an article through ruraltax.org where one of our colleagues has written an article on how to kind of go about doing that. And we can even talk towards the end about just a couple of things that you might want to take a look at or try to approach that situation if you don't already have somebody that you work with. So the main issues, and basis is probably where we're going to spend most of our time, but talking about basis, we'll do some calculations on how you kind of look at your gains from that. We'll talk a little bit about Form T, and these all kind of feed and flow into one another. And then we'll talk about reforestation maybe after we've made a sale. So Kurt touched on this a little bit, but what is your basis? And you've probably heard that term and you're like, I don't know exactly what that means. And this is not just for timber. I mean, it's really for any type of asset that we might talk about. And really the basic definition is your amount of investment in a piece of property. And we're going to walk through a couple of examples for this, but I wanted to mention too, for the IRS, their website is really pretty good from they produce quite a bit of resources and try to have education out there for tax preparers and tax filers to be able to find and understand information related to things that may impact them. So there's a publication 551. It's about 12 or 13 pages, so it's not too long. I wouldn't say it's the most exciting reading that you will do, but if you really want to have a better understanding of what basis is and how it's looked at and calculated, then that's a pretty good publication. And again, it's not just from a timber or lands standpoint, but it's really for any type of asset that you might talk about or think about or have to deal with in your day-to-day life or with your business and things like that. So with our basis, the reason it's important, it determines how much we are able to possibly depreciate and take as an expense related to some of our taxes. With the natural resources, depletion is really the word that we use we say we would deplete the basis for those natural resources. It's a pretty similar calculation. So you don't really use them interchangeably, but it's a similar thought process. So depletion is really what we talk about with timber, but it also determines our gain or loss when that property or when that asset changes hands. And as Kurt has already mentioned, your basis depends on how you acquired that property. So again, it's your investment in the asset or in the property, and your basis is going to depend on how you acquired it. So we're going to walk through a couple of examples. So on the purchasing side, let's say you bought an asset, and I wasn't going to be specific about the asset or about the time period necessarily, because that can send you down a couple rabbit holes. But again, to be simple about it, let's say you bought an asset for $100, and sometime later in the future, you decide to sell that asset and you sold it for $150. And so the question, and we're going to do these through poll questions. The first one would be, what was your basis? So we can pull up the next poll question. Okay, yeah. So you can go ahead and respond to both of those. So I'll go back here just so you can see it. So you bought the asset for $100 and later you sell it for $150. And so you can go ahead and respond what you think the answer is. What was your basis and what is the gain? And so Kurt kind of already touched on how this is looked at and how you determine your basis for this situation and each of these situations, but we'll see if you're paying attention here. All right, so we've got our results back, and great. So most people they got it right. So good job. So yeah, if you bought the asset, it's how much you purchased it for. And so in this case, we said we bought the asset for $100 and later we've sold it for $50. And so our gain is the difference between what we sold it for and what our investment or what our basis was for that asset. And so our gain in this particular instance was $50. All right, so next situation, let's say you were gifted an asset that the owner bought for $50. When they gifted it to you, its fair market value was $100. And similarly, you decided at some point in the future to sell it, and you sold it for $150. So we added kind of one more factor into that. And so same questions, we'll do the same polling questions. How much is your basis? And what was the gain? And so this is the situation where someone bought the asset, and at some point they said, I would like to give this to you. And maybe it's a family member, maybe it's a close friend. Any of those are eligible to give you a gift. And so they had bought it for $50. At the time they gave it to you, it was worth $100, and later you sold it for $50 or $150, excuse me. All right. So in this instance, we got a little bit of a split here. And so actually for gifting, you get what is known as carryover basis. And that means that whatever the basis of the original owner was, it carries over to you, both the basis value and the time period. And the time period comes into play a little bit later when we talk about our capital gains. But so in this particular instance, they bought it for $50. That's what transfers over to you. That becomes your investment in the asset. And then when you decided to sell it, you're selling it for $150. Your basis is $50. And so you had a gain of, the difference between those two is going to be $100. And so your gain ended up being more in this particular instance. So we added in about that fair market value. It was just kind of to test your knowledge there a little bit. So that's the second situation if we had a gift. And we'll move on to our final situation, which is a family member passed away. They had, kind of similar to these other situations, they had bought an asset for $50. At the time, when they passed it to you, when they passed away and you inherited it, the fair market value was $100. Later, you sold it for $150. So same questions apply. So what is your basis and what is your gain? And so you can see where, people will say, depending on the facts and circumstances of a transaction, or depending on the facts and circumstances of a taxable event, you can start to see how some of these things, depending on how it was ordered, depending on what happened, it's going to impact what the tax implications of that is going to be. And so we'll move to our responses here. And so, okay, we've got a good contingent, about 70% or so that was correct on the basis. And so the fair market value at the time of their death then becomes your basis when you inherit it. So a lot of times it's referred to as a step up in basis because generally the value of that asset is going to increase. And so whatever the fair market value at that time is, that is what you inherited at, and that becomes your basis in the asset. And so then later when you decide to sell it, someone said, well, I think that's worth $150, or I'm going to pay you $150 because your basis was $100. $150, the $50 is the difference between what they paid in addition to what your basis was from the step up in basis. Okay, so good. So we're just trying to do sort of a basic couple of examples just to give you an idea of how this works. So basis, it can go up or down. So depreciation and depletion are things that can cause your basis to go down. And so in those particular situations, I didn't change the basis at all, but there are different things that can have an impact on it. things like improvements, capital improvements, or capitalized cost, they could actually cause your basis to go up. And so once you start with it, that would be kind of like your original basis. And then once you start to have some of these things that either cause it to go up or down, that then becomes your adjusted basis. So if in this particular instance we said we depreciated it and it went down to 0 and we sold it for $150, then suddenly we have $150 of gain. But on the reverse side, if we capitalize something related to that asset and we added $50 of basis, then we'd be at $150 of basis and we would not have any gain if we sold it for that amount. So yeah, just kind of a quick primer there. And so with timber property, it works the same way. And so in some ways it's not a overly complicated calculation necessarily, but you can see how some of these things start to factor into one another and they can start to have an impact on some of these other areas. So the sometimes when it changes hands, the basis at that point is not shared or is not determined at that point. And so it sort of just gets, there might be a number associated with that timber and with that land, but it just gets sort of lost over time. And if we think about timber, it's something that really we have for a long period of time. And it might be that we had the records initially, but it got stuffed in the back of a file cabinet. We forgot about it. It got thrown out or something. And really it might just get lost over time. And the other issue, which Kurt touched on a little bit, is that in a timber property transaction, we're not just transferring one asset, but we know there are at least 2 assets that we are transferring, which would be the land and the timber itself. So there's a little bit of homework that we have to do from that standpoint. So there are multiple assets in that timber property transaction. And let's say in a given scenario, you bought something for $500,000 was the sale price. And we've got several assets that are a part of that. We would have the land, we would have buildings, and we would have timber on that property. And so a lot of times you might see some scenarios where this is broken out as far as the values for each, but a lot of times it just says, the contract or whatever it might be, probably just says $500,000 as far as the sale for that. And so it doesn't say, $150,000 for land, $250,000 for buildings, $100,000 for timber. We just see $500,000. So as another quick question, do you or your clients know their timber basis? And not necessarily the ideal answer would be yes, but it might be you are not exactly sure. Maybe it's something that you think you have on file, but you haven't looked at it for a while or something like that. Or perhaps you don't have any timberland yourself, or you're not working with any clients, in which case, just say not applicable to you. But just as a quick check, and for our purposes, like, do you or your clients know their timber basis currently? All right, we had a pretty even split on this one. So about a fourth for each question. So about a fourth for yes, about a fourth for no. We also had not sure and not applicable. So I am glad to see that about 25% say yes, they do know their basis. So that's great, and we just try to bump that number up just a little bit more. So in the transaction where we have purchased that property, and so to go back to that example I was just kind of mentioning, let's say we have that $500,000 sale price where we have land, we have timber, and we have buildings associated with that transaction. And so one way that, and really like the official way to go about doing this, so we have the sales price, and then we can use appraisals from independent appraisers to value like the land and the buildings. And then I think Kurt touched on this a little bit, but we would use maybe a consulting forester to come out and give us a value on the timber. And you might even break that out further into your merchantable, which is, it could be marketed pretty much today or as it currently stands. And then we have maybe some pre-merchantable that it still has some time. There's some value there, but it still has some time before we're really going to sell it or do anything with it. And so once you have come to the fair market value, so that's where those appraisals and those consulting foresters come into play, and they give you a total value for these items. And so I kind of created these fair market values. So 200,000 for land, 100,000 for buildings, and 220,000 for the timber, both the merchantable and the pre-merchantable. So we take the percentage of, say, like 200,000, how much of that makes up that 520, which gives us 0.385. We multiplied that by our original sales price of 500,000, and that gives us our basis for that scenario. So that gives us the basis for the land. It gives us the basis between all of these different assets. So in this case, we've got 144,230 for the merchantable timber, 67,307 for the pre-merchantable, and so on. So that is in the case of a purchase. If we inherit it, or if we had a gift, like for inheritance, we know that we're going to get the fair market value, most likely maybe through some of the legal proceedings of like an estate and things like that. The estate is probably going to be valued, and some of this work may be done for you already, but if not, you would still sort of go through that same appraisal process. But whatever they determine as the fair market value would then become your basis in those assets. If we have a gift where it's handed down to us, someone is still living, but they decided to give us a gift of these assets, they might have historical records. And then again, if it's been a long time, they may or may not. If they haven't, that's great. That's probably not the most common situation. Kurt already mentioned this, but you can do a back cruise on that timber where if we can say, well, okay, what was the value of that timber and what was the basis of that timber when the original owner had acquired it? Like, what's the basis at that point? And now that basis has been handed over to us. And you do have to account for things like sales and things like thinning that may have happened in that time period. But that back cruise can then give you some basis to go on in like a gifting scenario. And really, if it has been held for a long, long time, and there's actually going to be a decent amount of cost to get those appraisals and to get those consulting foresters to work on it, if it's been a long, long time, it's honestly probably not worth it because there's probably not much basis. And in that scenario, you're really not going to see much benefit from it anyway. And I think I mentioned this later, but if you can't prove or if you don't have verifiable data for the basis, then it's just assumed to be zero at that point. And so with the timber, just to kind of follow this example, so we're going to use the basis of the merchantable and say 144,230. And let's say we had a lump sale of all of our timber in this particular instance, all of our merchantable timber for 200,000. And so we would take our basis. Most likely we're going to have some costs associated with that sale. So I just estimated some cost there, and that would give us a gain of 50,770. So again, as your basis goes up or down, that's going to impact how much gain that you're going to have from that. Maybe another common scenario would be like a pay as cut scenario where we're not cutting everything, but over time, maybe it's every couple months or over a year or so or something like that. We're actually just going to deplete the timber basis as we cut it. And so in this particular instance, I said roughly a fourth was cut, so 25%. Did a similar sales price, and we would just take 36,000 of that timber basis, which is 25% of that original 144 from the basis of the timber, with the 75% remaining for our other cuts. We'd have some selling costs, and then calculate your gain from there. So that's The depletion is really calculated on a per unit basis. And so there's a little bit more of an official calculation, but basically this is how it works in practicality. From a timber sale, you're going to receive a 1099, and probably all the information that's going to show on that is who paid for the timber, who is buying it from you, and then what the sales proceeds from that was. And so then it's kind of up to you as far as being able to provide that historical data on what the basis was. And again, if it can't be established, or it's not really a verifiable number, if the IRS were to come in and question it, they're just going to presume it to be zero. Again, if it's so historical and it's been handed down through gift a number of times, it's probably going to be pretty low regardless, but just kind of a note there. So from the investment standpoint, timber is treated as a capital asset, and you get capital gains treatment. The long-term capital gains are always more favorable as far as the tax rates. Sometimes I hear people say they're trying to avoid capital gains or something like that, but really the tax rates are always favorable for capital gains. Now, the long-term is much more favorable, and it depends on what your current level of income and your current level of tax rates are, but it's going to be taxed at either 0, 15, or 20%. And so anyways, those are always favorable. The Form 8949 and the Schedule D are the actual tax forms where this would be computed and shown on your tax return. I wasn't going to show that, but just for your information. And even if you do have short-term capital rates where you've held the investment for less than a year, and I don't think of that situation happening that often, but you still get some benefit from that because you don't have to pay self-employment tax. There is the NIIT, which is a net investment income tax, which is if your income is 200,000 or greater if you're single, or 250,000 if you're married filing jointly, that if your income is above that level, then you have a 3.8% tax, like surtax, on top of your investment income. So just kind of a quick note about that. So that's the investment side. On the business side, timber sales from business can receive more favorable capital gains treatment as well. They use a little bit different forms. It's a Form 4797, and most likely it's going to show up on the Schedule F or the Schedule C. But they can do that through a 631 election. And I'm not going to get into the particulars of that, but basically it's as if the person sold it to they sold the timber at the beginning of the year for capital gains treatment, and then they sell it again, and there's some ordinary income recognition from that. But if you make that 631 election, it allows the business to also take advantage of the capital gains rates, which again are always going to be more favorable. I will say on the business side, if you held the asset or the property for less than a year and you make a sale from it, they actually receive ordinary gain treatment. And so that's going to be higher tax rates. It's also going to be self-employment tax. And that's the 1231 asset. That's just kind of a reference to that. And you can take a look at that if you'd like to. And then the Form T is the form where you actually can see a lot of this and how it's calculated and how it's reported on this particular form. So page 1 is the acquisition of the property. Page 2 is like you're tracking the basis through the different assets, including like the land and the improvements and the timber, both merchantable and pre-merchantable. Page 3 is going to be sales, and then it'll also have some information for reforestation. Just from a practical standpoint, really it's required to file Form T for someone that is in the business. And although it may not be required for an investor, it's really just a good practice to actually use this form. It's good from a record keeping standpoint, and it helps you to track your basis and all those different things that are really important anyway to calculate and to report your information correctly. So that Form T, I've included links for a number of these different things that I think Bob is going to share or has already shared. And so you can take a look at the form. The instructions are, I think, 4 or 5 pages, and it really walks through the whole form, maybe the numbers that they're looking for, how to make some of the calculations and things like that. Didn't necessarily have time today, but just want to mention that. And I didn't figure a lot of people would be necessarily filing this themselves, but again, just to like make you a little bit more familiar with it. And then the reforestation expenses. So after you've made a sale of the timber's been cut, you are allowed to deduct $10,000 per qualified timber property for your reforestation expenses. And that qualified timber property, that you can break up your tracts, and you're allowed that $10,000 per property. So it can't necessarily just be that, okay, well, I'm just going to say I'm going to break up this 10 acres and then I'm going to break up another 10 acres. It has to be something a little bit different, like maybe it's a different species. Maybe it's I would think of if you had timber in one location and then you've got timber maybe 20 miles away in a different county, and those tracts and stands were started at a little bit different times. In my mind, that's like a different timber property. So you can read up a little bit more on that. Section 194 is the Internal Revenue Code for that. But so let's say you spent $15,000 as far as reforestation expenses, you would get to deduct $10,000 for this year, and the remaining $5,000 would be amortized over the next 84 months, which is essentially 7 years. But I think there are some planning opportunities with this, because whether it be from a timing standpoint, so like maybe you take 10,000 this year and you say, well, I know, I'm going to do this particular section this year, then I'm going to wait until next year and I'm going to do another 10,000 the next year. And you could even, from a timing standpoint, if you did it in December as far as your reforestation, and then you completed the next reforestation in January of the next year, you're in 2 different tax years there. And so you're able to take advantage of that reforestation. So it mentions here the cost and things that you're allowed to take for that. It is important to note that the personal labor is excluded, because I think sometimes people, they may not have a lot of other costs and they're just going to do a lot of it themselves. And so they contribute a lot of time, but I think there was some fraud. I shouldn't say necessarily fraud, but people were maybe taking advantage of that situation and saying that they were contributing a lot of hours to doing that. So the personal labor is excluded. But I think that you do have a planning opportunity, whether it's with the business or the investor, especially if you're working with a practitioner and you say, hey, I know I'm going to make a sale, but I'm also planning to do some reforestation. How can we kind of structure this in a way where we can minimize it and really take advantage of some of these provisions? All right. Those are some of the sources and resources I use for this presentation. I think all of these have been shared by Bob, as well as the presentation itself. So I'll just quickly move through that. If you have specific questions, I know we're going to take some here at the end for a few minutes. That is my contact information. If I might defer a couple questions, if I don't know the answer off the top of my head. But if you'd like to get in touch sometime later, would encourage you to do that as well. So I'll stop there, and so that we have a little bit of time here at the end.
Thank you, Kevin. We do have a few questions that have come in, so we'll get started with those. And Kurt, also thank you for your presentation. The first question is from Lee Murphy. If the timber is valued separate from the land by the property tax assessor, will the IRS accept that value as the basis when the timber is cut? So for example, in 2012, the property tax value for the timber is established, and then it was cut in 2022.
Yeah, so the property tax is really not a great way to establish your basis. It's really better to get an official appraisal for that and use a consulting forester in the case of the timber. So a lot of times for tax purposes, they're valuing it a little bit different, and they kind of have some formulas and things that they're running it through. So really the best way to do it is to get someone that's going to come out and give you like the true fair market value for those assets.
Okay, the next question is from Charles Grant. If the timberland is in a trust and the primary owner dies, what would be the basis at that point?
I guess it depends on how that asset is then transferred. If it's transferred to another entity or another owner, or if it stays in the trust. So it's kind of a question of what happens then to that particular asset. So if it stayed, I mean, it would essentially be the same um, same basis. But if it moved somehow to another owner or something like that, then it would change at that point.
Okay, a question from Charles Grant. He received a payment adjustment from the Florida Timber Recovery Block Grant paid in 2023, resulting in a complete loss due to Hurricane Michael. Has this got to be claimed as long-term capital gains or just income?
I'm not as familiar with that program from Florida, and sometimes it's includable, sometimes it's excludable. I think in looking at these presentations that Tammy Cushing, I think, has done some information. I know she works in Florida. I would probably direct you towards her because I feel like she's probably dealt with that question a handful of times.
Okay, question from Laura. Is the tax treatment the same for property held as a hobby / personal? And can you still offset your basis of the timber for that type of holding?
Yes, but you're not allowed to take any deductions really. So you have to report all of the income from that, but you're not allowed any of the other like operating expenses or anything like that. And so it shows up as ordinary income on your return. It doesn't get the more favorable treatments, and then you're not required to pay self-employment tax on that, but you're very limited as far as any deductions from a hobby standpoint. Now, it used to be you could get some miscellaneous itemized deductions. They may be coming back after 2025, but as it currently stands, no deductions for that.
Question from Nathan Gatlin. Is it better to have timber basis determined when the forest is acquired or wait until it is sold and use the equations to backwards determine the value, or does it matter?
I would say always when it changes hands, and that's going to be the most accurate. So if you try to go back, 5 years may not be that bad, but if it's 10 years or 20 years, you can imagine you're probably going to get off as far as your calculation. So I would almost encourage you, anytime that property changes hands, then that's when you'd want to have it appraised.
Okay, question from David Lewis. When setting a pre-merchantable timber value, should you include the present value of future income flows, example, pine straw sales, hunt leases, etc.?
I think the consulting forester would probably be a better person to ask that question. They, I think, would have a more official process on how they're going to value that. And just speaking truthfully, I'm not exactly sure how that works. I don't know if Kurt or even Bob, if y'all can speak to that some, but I'm not as familiar with how they would value that. But that would be part of the consulting forester coming out and giving a value for that.
All right. Next question is from, not sure the person's name, but they'd like you to share your reference slide again. I will post that back in the chat so that people have access to those links and stuff. So I'll take care of that one. Question from James Comer. How is land classified if it was deeded to you 20 years before your parents' death?
That would sound like a gift to me. If they're still living and then they passed it down to you, that sounds like a gift to me.
All right. Next question is from an anonymous attendee. If the land was purchased with only timber, no buildings on the property at 2,500 per acre, would the basis be determined by determining the value of the timber at the time of the sale? Or could it be valued by subtracting the value of the land from the sale price?
Yeah, so there is, if you have the fair market value at the time of the sale, there is a way that I think it's called the residual method, where you can pull out what the land was worth. And then if it was only, say, like those two assets, like the land and the timber, then the remaining amount you could allocate to the timber account or the timber asset at that point. But you have to know kind of that fair market value at that time.
And this is just a comment from Robin, who said the timber value the tax assessor states is not the actual timber market value at all. It is the productivity value based on species composition and soil productivity class. And that is true here in North Carolina.
Yeah, that's a good follow-up.
All right, folks, we'd like to thank you for attending today's webinar and your questions. At this time, I'd like to thank our speakers, Kevin and Kurt, both of you for taking the time to put this webinar together, and we appreciate it very much. The webinar is being recorded. You will be able to go back and watch it again at the same link you used to join today's webinar. And with that, thank you all for joining.
All right, thank you.